That's an interesting point you raise about the units of measurement, and I guess do you see a risk that when it comes to shorting equities, for example, a lot of investors think they have an edge in shorting, but that is done in nominal terms. It's done in a unit of measurement that I guess relies on stability. But if the actions you outlined lead to inflation or hyperinflation, it's conceivable that the equity indices could go to very, very high levels in nominal terms.
Exactly.
Not in real terms. And strategies such as shorting could really not work well if that were to happen. Is that how you think about some of the risks of this type of activity?
Definitely. Because today there is some kind of a paradox in the market where people who look at the fundamentals of the economy are seeing relatively very weak fundamentals, be it in the unemployment, be it looking at the Baltic Dry Index, which measures the global activity in the economy, be it in the housing market. We had the Case-Shiller housing index hitting a 10-year low a month or so ago, be it in the number of Americans on food stamps, over 40 million. So we have a stack of really bleak economic indicators, yet the S&P is going up. And people cannot make sense out of this divergence between the actual prices of the S&P and against like really negative fundamentals. And I see two reasons for this divergence. One is that investors are literally being forced to go into the equity category because they do not want to be into a 10-year bond yielding 3%. They are afraid that the dollars are losing value, and they are finding refuge in the equities. So they are buying the stocks just to protect their value from like diminishing. This is the first thing. The other part is that the central bank is trying to lift all risky assets except the commodity complex. They're trying to lift the equities. And we have done some research which uncovered a very interesting inefficiency, I would call it, meaning that equities have primarily gone up during illiquid hours, which we suspect has to do with the stabilization efforts that the Fed is doing and trying to lift the equities, and hence they've been buying the E-mini futures in the illiquid hours of the market, meaning overnight when not many hedge funds are trading against them, just to have more price lifting effect of the equities. So these two elements, one, investors are being channeled into the equity space, is adding a flow into the equity sector. On the other hand, the Fed is also deploying immense amounts of liquidity into the equities to lift the overall market for many reasons.
So just to perhaps if you could give a few examples then, where do you see the most interesting inefficiencies in terms of, I guess, their size and the potential to exploit them profitably with your strategy?
Yes. As a trader myself, the first rule is that I do not try to change the world. I accept what I see. So when I know that we have, institutions like the Fed with an infinite firing power, buying the market, I think it is very risky to try to go short and bet against what I see obviously as someone pushing up the market. So I'm not trying to change the world. I'm not trying to bet against an 800-pound gorilla either. So we have to accept it. So the first step for me is to accept and understand what is going on. And we've done a lot of research, and we have uncovered many patterns of this like almost artificial buying of the S&P as a market. Now, people may not believe this, but remember that the Fed has been able to subdue the long-term interest rates to 3%. So an institution which has enough firepower to control the fixed income market, the S&P is really small compared to the bond market. So they definitely can influence the S&P. I'll give you an example. I went short in October of 2011, the S&P, when there was almost a panic, when the economy was being shown as weak and fragile. And out of nowhere, late in October of 2011, we had this massive rally, and now almost 40% in 4 or 5 months. So the Fed not only waited to lift the markets, but they are trying to squeeze anyone who goes short to force them to buy back their positions, and they get more for their active buying in the market. In terms of how to exploit that, it's very difficult to anticipate what the Fed will do or when. And when I say the Fed, it's not really the Fed, but maybe their top primary dealers and other banks they work with. So it's very hard to forecast what your counterparty will do. So the best thing I can do is go with the flow, and this is why we look for patterns, be them directional, where we go with the trend, like momentum-based patterns, or counter trends where we wait to buy on a dip and within maybe a larger trend or so. This is the technical approach I feel most confident with, because regardless who's buying and who's selling, as long as you can find a good place to be and go with the main trend, you probably will not be fighting a bigger person than you think you are.
Curious, so your analysis, on which level does it play out? Do you analyze certain industries also? How deep do you go into any specific industries or stocks, or companies even, to look for inefficiencies?
Yes, our approach really combines the best of both worlds, in my opinion, be it the CTA or technical trading in a systematic manner with a global macro overlay where we have a basic understanding of the dynamics between different markets and elements working together. We use the global macro approach to choose the markets that we want to trade, which tend to be the deep and major markets like the energy markets, the equity markets. We only trade futures, by the way, primarily futures, and the foreign exchange, and some agriculture as well. So we use our global macro approach to select which markets and assets that we want to trade. And once we have defined our portfolio of candidates, then we use a technical quant-based algorithmic trading on these selected markets. And of course, we have a risk management framework everywhere, which applies to all markets and regardless of their category. In terms of how deep we go, we do not go to the individual security if we want to trade, because we do not focus too much on the individual asset. We look more at the dynamics between the major assets at the index level, be them in equities or energies or commodities.
And are you focused on any specific geographies, or do you do this globally?
We do this globally, mainly in the US, Europe, and Asia. The other thing I can mention here is that over the last few years we have seen a huge amount of convergence among different categories of assets. For example, before 2008, the market was much healthier in the sense that every market had its own character, be it the energy market, be it the copper market, be it the agricultural markets, be it the European economy compared to the US economy, compared to the Asian economy. After 2008, we have seen a loss of granularity of different markets, where the whole game has become either we are taking risks or we're not taking risks. So we have seen a clustering almost of every risky asset which would fall exactly within the same bucket. So now we have fewer opportunities really to diversify the portfolio, because to a large extent markets are driven now by liquidity and by risk perceptions. As a proof of that, we have done a lot of multi-factor analysis where we look at the patterns of the markets between different assets, which used to be really well behaved and well sparse among one another, and now after 2008 we see them as a group behaving together up or down against the US dollar as well, and gold and silver. So the intervention which began in 2008 on, at a larger scale continues to have a big effect on the macro markets, and one cannot ignore anymore this major change in the rules of the game.